There are countless patterns that traders rely on, but in this video, we'll focus on the ones that helped me and my partner make over $2 million in profit last year. Let's get started with the first pattern on our list, the double top and double bottom. We'll start with the double top. Imagine the price is in an uptrend, moving higher. At some point, it reaches a certain high twice. These two peaks form what we call a resistance level, and the low point between them creates what's known as the neckline. From a price action perspective, what does this double top tell us? Essentially, it indicates that the price tried to move higher, but couldn't break past the previous high. This signals a loss of momentum from the buyers, suggesting the uptrend is weakening. On the flip side, we have the double bottom. Here, the price is in a downtrend, moving lower. Then, it hits the same low twice, forming a support level, with the swing high between them creating the neckline. What does the double bottom reveal? It shows that the price failed to make a lower low, indicating that sellers are losing strength, and the downtrend is losing momentum. Now that we understand these patterns, the important question is, how do we incorporate the double top and bottom into our overall trading strategy? Let's dive into the 3 key variations for using the double top and double bottom patterns effectively. We'll begin with the first one, the neckline break entry. Let's start by looking at the double top pattern. You'll notice that after the 2 highs are formed, a neckline is drawn based on the recent swing low. The key moment comes when the price breaks below that neckline and makes a lower low. This confirms the trend reversal, and at this point, you'd enter a short position, as the market is signaling a shift from bullish to bearish. Now, flipping this to the double bottom pattern, the neckline forms based on the recent swing high. Once the price breaks above this neckline and makes a higher high, the trend reversal is confirmed, signaling an opportunity to take a long entry. This indicates the market is transitioning from bearish to bullish. Next, let's explore the second variation, which involves identifying a double top or double bottom pattern at a key level. You need to identify a key level, which can be done by spotting reversal points. As the price comes back down, it forms a double bottom pattern right at this key support level. To confirm the reversal, you place the neckline at the recent swing high. Once the price breaks through that neckline and makes a higher high, the trend changes from a downtrend to an uptrend, and you can enter a long position, typically on a lower time frame. Another confirmation method you could use involves drawing a trend line connecting the swing highs. Once the price breaks through this trend line, you have an additional signal to enter a long trade. So, what does trading a double top or double bottom at a key level tell you about price action? It offers a higher quality entry because you're not only trading the pattern itself, but you're also factoring in a key level of support or resistance. This attracts both support resistance traders and pattern traders, increasing the momentum behind the trade and ultimately improving trade quality. Now, let's move on to the third variation. Instead of taking the breakout entry immediately, you could wait for the price to pull back to the newly established support level. This second entry on the pullback often provides a better and more secure opportunity. What makes this level particularly attractive is that it was formed earlier, making it a strong point of reference. If you're enjoying this video so far, please hit the like button. We'd greatly appreciate it. Now, let's move on to the next important pattern, the head and shoulders. Once the head and shoulders pattern is formed, you'll notice that the neckline is drawn based on 2 key points, the lows for the head and shoulders, or the highs for the inverse head and shoulders. The key signal for entering the trade is when the price breaks through this neckline. For the regular head and shoulders, once the price breaks below the neckline and makes a lower low, it confirms the reversal and the trend change from bullish to bearish. This is when you'd take a short entry, expecting the downward movement to continue. On the flip side, with an inverse head and shoulders pattern, once the price breaks above the neckline and makes a higher high, it confirms the reversal from bearish to bullish. This is when you'd take a long entry, as the uptrend is now confirmed. Now, let's move on to the second variation of this strategy. Instead of taking the breakout entry right away after the neckline break, you can wait for a pullback. This means waiting for the price to retrace back to the neckline, which now acts as either a support, in the case of an inverse pattern, or resistance, in the case of the regular head and shoulders. This pullback entry can often offer a more secure point to enter the trade. Next, let's explore the third variation. Typically, traders wait for the pattern to fully form and take a trade once the neckline is broken. However, there's a more advanced strategy that involves taking an early, aggressive entry right at the right shoulder of the pattern, allowing you to anticipate the trend change before the neckline break. Here's how it works. First, you identify the left shoulder, followed by the head of the pattern. The key here is that the left shoulder already establishes a resistance level, or support in the inverse pattern. As the price moves back up to this resistance level, you start looking for candlestick patterns that indicate a reaction to the resistance level, long wicks, or other signs of price stalling, for example. These candlesticks suggest that the price is struggling to break through the level, setting up the right shoulder. Once you see this reaction, you zoom into a lower time frame to look for additional price action that signals a potential trend change, confirming the formation of the right shoulder. Let's say you pull up the 1-minute time frame alongside the 5-minute. On the 5-minute chart, you've identified the key resistance level where the right shoulder should form. Now, on the 1-minute chart, you see a descending triangle pattern forming right at that resistance level, adding further confirmation of a potential reversal. When the price breaks below the descending triangle, this confirms the reversal from an uptrend to a downtrend, and also completes the right shoulder of the head and shoulders pattern on the higher time frame. At this point, you'd enter a short trade, capitalizing on the confirmed trend change. If you want to be notified when we publish new free videos, subscribe to our channel and hit the notification bell. Now, let's move on to the next section: triangles, channels, and wedges. These patterns are grouped together because they work as part of the overall structure of how we approach and analyze price action. You'll see how each of these patterns fits into our strategy and why they are so powerful when used as a set. Let's begin by breaking down the 3 core patterns, starting with the triangle pattern. We'll explore its variations and how it fits into the broader picture of trend continuation or reversal. Ready? Let's dive into the details. The triangle pattern comes in 3 variations, each with its own characteristics and market implications. Let's start with the ascending triangle. In the ascending triangle, the top side of the pattern forms a horizontal resistance level as the price makes the same high multiple times. The bottom side, however, forms higher lows, creating an upward sloping trend line. This pattern typically appears in both bullish and bearish markets. In a bullish ascending triangle, the price is in an uptrend leading up to the formation of the pattern. The higher lows show that buyers are gaining strength, and once the price breaks through the horizontal resistance, it confirms a continuation of the uptrend. In a bearish ascending triangle, the price starts in a downtrend. The higher lows show some buying pressure, but if the price breaks below the support level, it signals a continuation of the bearish trend. Next, we have the descending triangle. The bottom side forms a horizontal support level as the price hits the same low repeatedly. Meanwhile, the top side forms lower highs, creating a downward sloping trend line. In a bullish descending triangle, the price is in an uptrend leading into the pattern. The lower highs show that selling pressure is increasing, but if the price breaks below the horizontal support level, it signals a potential trend reversal or continuation of the downtrend. In a bearish descending triangle, the price starts in a downtrend. The lower highs confirm that sellers are in control, and if the price breaks below the support, the downtrend is likely to continue. Finally, we have the symmetrical triangle. In this variation, the top side makes lower highs, allowing for a descending trend line, while the bottom side forms higher lows, allowing for an ascending trend line. This creates a tightening price range as the 2 lines converge. In a bullish symmetrical triangle, the price starts in an uptrend. The lower highs and higher lows indicate a consolidation period, but once the price breaks above the descending trend line, the uptrend is likely to continue. In a bearish symmetrical triangle, the price starts in a downtrend. The pattern indicates a pause in the market, and if the price breaks below the ascending trend line, it signals the continuation of the downtrend. Now, before we dive into the strategy for using these patterns, it's important to understand one critical concept. When you're drawing lines to identify patterns, treat them as approximations, not precise levels. The market is imperfect and patterns don't always form in a textbook, picture-perfect manner. If you only wait for flawless patterns, you'll miss out on the majority of good trades because price movements are often noisy and far from perfect. To be a successful trader, you need to learn how to operate within this imperfect and sometimes chaotic market, adjusting and adapting as you spot patterns that may not be 100% perfect but are still valid. With that in mind, we'll show you how to use these patterns in your trading strategy once we move into the next section. If you want us to make more free videos on a specific topic, consider leaving it in the comment section. Next, let's move on to the channel pattern, which comes in 3 variations. These patterns are defined by 2 parallel trend lines that act as support and resistance, guiding price movement within a channel. Let's break down each variation. We'll start with the ascending channel. In this pattern, the top side forms higher highs and the bottom side forms higher lows, creating 2 upward sloping, parallel trend lines. These lines guide the price as it moves within the channel, making higher highs and higher lows. In a bullish ascending channel, the price is in an uptrend, and the pattern forms as the price continues to climb. The higher highs and higher lows suggest that the uptrend is intact, and you can look for buying opportunities along the lower trend line, support, or breakouts above the upper resistance trend line. In a bearish ascending channel, the price begins in a downtrend, and while it appears to be climbing, the channel formation indicates a potential continuation of the downward movement. This can be a signal to prepare for a bearish breakout or reversal. Next, we have the descending channel. Here, the top side forms lower highs and the bottom side forms lower lows, creating 2 downward sloping, parallel trend lines. The price moves within this channel, gradually making lower highs and lower lows. In a bullish descending channel, the price starts in an uptrend, but the formation of the descending channel suggests a temporary pullback. Traders often look for buying opportunities when the price breaks out above the descending trend line, signaling a continuation of the uptrend. In a bearish descending channel, the price begins in a downtrend, and the channel formation confirms that the downward momentum is still in place. Lower highs and lower lows indicate that sellers remain in control, and traders may look for opportunities to short the market, especially when the price breaks below the lower trend line. Finally, we have the horizontal channel, also known as a range-bound market. In this variation, the top side forms consistent highs, creating a horizontal resistance level, while the bottom side forms consistent lows, establishing a horizontal support level. The price moves sideways between these 2 parallel levels. In a bullish horizontal channel, the price starts in an uptrend but consolidates within a range. This often indicates that the market is taking a breather before continuing its upward momentum. Traders can look for a breakout above the horizontal resistance level to confirm the continuation of the uptrend. In a bearish horizontal channel, the price starts in a downtrend and consolidates within a range. The pattern indicates a pause in the downtrend, but if the price breaks below the horizontal support level, it signals the continuation of the bearish movement. Each of these channel patterns, ascending, descending, and horizontal, provides you with opportunities to identify trends and potential breakouts, whether the market is trending upwards, downwards, or moving sideways. By understanding how the price interacts with these channels, you can plan your entries and exits more effectively. We also publish free short educational videos on TikTok. Follow us at Bayman Capital. Now let's move on to the wedge pattern, which comes in 2 variations. the rising wedge and the falling wedge, which patterns are unique because the two trend lines that form the wedge converge, signaling a potential breakout as the price movement tightens. The first variation is the rising wedge. In this pattern, both the top side and bottom side are moving upward, with the top forming higher highs and the bottom forming higher lows. However, the key characteristic of the rising wedge is that the two trend lines are converging, meaning the range between the highs and lows is getting smaller. In a bullish rising wedge, the price is initially in an uptrend, and the rising wedge forms as a continuation pattern. But be cautious. While it can break to the upside, a rising wedge often signals a reversal. If the price breaks down below the lower trend line, it confirms a bearish reversal, even though the overall market may still appear bullish. In a bearish rising wedge, the price starts in a downtrend. The rising wedge pattern forms during a pullback, but the price is likely to break below the bottom trend line, continuing the bearish momentum. Next, we have the falling wedge. This time, both the top side and bottom side are sloping downward. The top side forms lower highs and the bottom side forms lower lows, but just like the rising wedge, the trend lines are converging, indicating a potential breakout. In a bullish falling wedge, the price is in an uptrend, and the falling wedge forms as a consolidation or retracement. The tightening price range suggests that a breakout is imminent, and when the price breaks above the upper trend line, it signals a continuation of the uptrend. In a bearish falling wedge, the price starts in a downtrend, and the wedge forms as part of a consolidation phase. The price may continue downward, but the falling wedge typically signals an impending reversal. A breakout above the upper trend line would confirm a bullish reversal. Now that we've covered the three core patterns, triangles, channels, and wedges, it's time to discuss how you can use them effectively in your trading strategy. These patterns provide insights into potential breakouts or reversals, whether the market is moving in a clear trend or consolidating. By recognizing these formations and understanding how they signal changes in market direction, you can plan trades that align with price action and market momentum. Let's dive into how these patterns fit into your strategy in the next section. The core principle of trading with triangles, channels, and wedges is to follow the direction in which the pattern breaks. This rule applies regardless of the specific variation, whether it's an ascending, descending, or symmetrical triangle, or a rising or falling wedge. If the price breaks above the pattern, you would enter a trade in the direction of the breakout. Long, if the price breaks below, you would trade in that direction. Short. Here are the various strategic approaches you can apply when using these patterns. Trend plus pattern plus break in main trend direction, trend trade. Trend plus pattern plus break in opposite direction, reversal trade. Trend plus pattern plus break in main trend direction plus pullback entry. Trend plus pattern plus break in opposite direction plus pullback entry. Key level plus pattern formation. Key level plus candlestick pattern plus pattern inside. We also share free short educational videos on Instagram. Follow us at Bayman Capital. Let's start with the first strategy, identifying a trend, followed by the formation of a pattern, and then trading the breakout in the same direction as the main trend. This is a classic trend trading strategy. For example, you have a strong uptrend, and then a descending triangle pattern forms. While it could have been any of the patterns we discussed, in this case, it's a descending triangle. When the price breaks above the upper trend line of the triangle, it signals that the bullish momentum is strong enough to break the pattern and push the price higher. This breakout confirms a trend continuation, and you would look for long trades on the lower intraday timeframe, as the trend is expected to keep moving upward. Let's look at another example. The price is moving in an uptrend, and a descending channel forms. Again, this could be any pattern, but here we have a descending channel. When the price breaks above the upper trend line, it confirms a continuation of the uptrend. You would take long trades in the lower time frame to capture the momentum as the market continues in the same direction. Now, the same logic applies in a downtrend. Imagine you have a downtrend and a descending triangle forms. In this case, when the price breaks below the lower trend line of the pattern, it signals a continuation of the downtrend. You would then look to enter short trades as the price continues to follow the main downward trend. This approach works in both bullish and bearish markets and allows you to follow the trend with confidence once the breakout confirms the continuation of the prevailing market direction. Now, let's move on to the reversal trading strategy. In this approach, you first identify the main trend, followed by the formation of a pattern, but instead of continuing in the direction of the trend, the price breaks in the opposite direction, signaling a trend reversal. Let's say you're in an uptrend and an ascending triangle forms. While this pattern typically signals continuation, in this case, the price breaks below the lower trend line, indicating a potential reversal. This break in the opposite direction of the uptrend signals that the buyers have lost control and a downtrend may be forming. In this scenario, you would look to take short entries as the price breaks downward, confirming the trend change from an uptrend to a downtrend. Similarly, the reverse applies in a downtrend. Let's say you have a falling wedge pattern forming during a downtrend. Normally, you would expect the price to continue downward. However, in this case, the price breaks above the upper trend line of the wedge, signaling a potential reversal from a downtrend to an uptrend. This break in the opposite direction of the trend suggests that sellers are losing strength and buyers are stepping in. At this point, you would look for long entries on the lower time frame as the market transitions into an uptrend. This strategy works for both bullish and bearish markets and allows you to capitalize on trend reversals when the price breaks against the direction of the main trend. Now let's explore this variation of trend trading where you identify a trend, followed by a pattern formation and a breakout in the direction of the main trend. However, instead of jumping in immediately after the breakout, you wait for a pullback entry. This approach offers a more secure and potentially higher probability trade by allowing the market to retest the breakout level. For example, you're in a strong uptrend and an ascending triangle pattern forms. Typically, when the price breaks above the upper trend line, that's your signal to enter long. But instead of entering right away after the breakout, you decide to wait for a pullback. In this case, after the price breaks above the triangle, it pulls back to retest the breakout level, which has now become the new support. As the price pulls back, multiple long wick candles appear, signaling that the market is respecting this new support level. Additionally, the moving average crosses this level, creating an area of confluence, which adds further confirmation that the support is likely to hold. Once you see an intraday trend change, like the price bouncing off this level or forming a bullish candlestick pattern, you would then enter a long trade using your entry strategy and tools. Whether you choose to trade the initial breakout or wait for the pullback, both approaches are valid, and your choice depends on your trading style and risk tolerance. It's also important to note that breakout entries and pullback entries require different stop-loss placements. Understanding this distinction is key to managing risk effectively, and we'll cover it in more detail later on. By waiting for the pullback, you increase your chances of entering at a more optimal price, while also allowing the market to confirm the breakout with additional support. If you're enjoying this video, consider sharing it with a friend. Trading is more fun with friends. In this variation of the reversal trading strategy, you first identify the main trend, followed by the formation of a pattern. When the price breaks in the opposite direction of the main trend, instead of taking an immediate reversal entry, you wait for a pullback to confirm the reversal before entering the trade. This strategy allows for a more secure entry as you wait for the market to retest the breakout level. For example, the price is moving in an uptrend and a descending triangle pattern forms. Normally, you'd expect the uptrend to continue, but in this case, the price breaks below the descending triangle, signaling a potential reversal from an uptrend to a downtrend. At this point, more aggressive traders might take a short entry right after the breakout. However, if you prefer a more secure approach, you would wait for the price to pull back to the new resistance level, which used to be the lower boundary of the triangle. This pullback often occurs as the market retests the breakout level. In this case, you see a long wick candle forming at the new resistance level, which aligns with the bottom of the triangle and where the trend line crosses, creating an area of confluence. This confluence adds further confirmation that the resistance is likely to hold. Once you spot an intraday trend change, such as a rejection from the resistance or a bearish candlestick formation, you would then enter a short trade. This gives you more confidence in the reversal, as the pullback confirms the breakdown of the pattern. By waiting for the pullback, you can reduce the risk of entering too early in a false breakout scenario. Instead, you enter after the market confirms that the breakout level has held as resistance or support in the opposite scenario. This approach works well for traders who prefer to trade with more certainty rather than reacting to the initial breakout. In this variation, you combine the power of a key level with a pattern formation. The key level is typically a strong support or resistance level identified through previous price action, such as a significant reversal point. Once you've identified this key level, you then look for a pattern that forms around it, which provides a strong signal for a potential trade entry. Let's walk through an example. You've identified a key level from a past reversal point where the price turned around before. As the price returns to this key level, a descending channel pattern forms right at this point. While this descending channel could be any pattern from the list, its formation at the key level strengthens the trade setup. In this case, the price eventually breaks above the descending channel, confirming a reversal at the key level. This breakout signals that the price is likely to continue upward, reversing from the previous downtrend. At this point, you would take long entries as the breakout from the pattern, combined with the significance of the key level, gives you a higher probability of success. By combining a key level with pattern recognition, you're not only trading the pattern itself, but also leveraging the strength of support and resistance levels. This often results in a higher quality trade setup because multiple factors are aligned, giving you more confidence in the potential outcome. This strategy works for both bullish and bearish reversals, depending on whether the key level is a support or resistance zone, and can be applied to various patterns formed at these critical points. For more free educational content, follow us on X, Instagram, and TikTok at Bayman Capital. This variation takes the strategy a step further by combining a key level, a candlestick formation, and a pattern inside the candlestick action. This multi-layered approach allows you to identify potential trade entries with a higher degree of confidence. You start by identifying a key level where price action has reacted in the past. In this case, the price is in a moving uptrend, and after breaking a pattern, it pulls back to test a newly formed support level. This area of confluence includes the trend line and the new support level, providing strong indications that this level may hold. Step 2. Look for candlestick patterns. As the price approaches the key level, you observe candlestick patterns forming at this area of confluence. In this scenario, long wick candles appear, showing that the price is reacting to the level but is temporarily stalling. The candlestick formation suggests that buyers are defending this area, but price action alone isn't enough yet to confirm a trend change. Step 3. Look inside the candlestick for a pattern. Now comes the crucial part. You zoom into a lower time frame to see if any price action patterns, like triangles, wedges, or channels, are forming inside this area. For example, you might find a descending triangle forming within the candlestick pattern, right at the key level. This nested pattern gives you additional confirmation that a trend change may be about to occur. Step 4. Confirm the breakout. Once the price breaks above the pattern inside the candlestick formation, this confirms a trend reversal from a downtrend to an uptrend. In this case, the descending triangle that formed at the key level breaks to the upside, signaling a clear shift from bearish to bullish momentum. You would take a long trade when the price makes a higher high, confirming the uptrend. Key points to remember. Notice how the price doesn't always shoot straight up. Instead, it might pull back slightly before continuing the upward move. This highlights the importance of waiting for confirmation. One of the critical aspects of this strategy is the stop-loss placement. Understanding this distinction is key to managing risk effectively, and we'll cover it in more detail in a future video. This combination of a key level, candlestick pattern, and a nested pattern inside gives you a layered approach to identifying high-quality trades. It's a more advanced strategy, but when executed correctly, it provides strong confirmation and reduces the risk of false breakouts. If you made it to the end of this video, you're in good shape to become a successful trader. In future videos, we'll share the probabilities of all these patterns and explain the indicators we're using on our charts. So, if you don't want to miss out, subscribe and hit the notification bell. Thank you for your attention, and see you in the next one.